We have so far looked at the building blocks of managerial economics. Now, in this final session, I'd like to move over to look at the economic environment. Here, the flavour is more on what's known as macroeconomics. The particular situation I want to address is to look at inflation and unemployment. Now, within the ISLM framework, we can have inflation for two reasons. The first of these is where the money supply is too high, which gives us an equilibrium point of our ISLM curve beyond the full employment level of income. The difference here being known as the inflationary gap. Second way in which we can have inflation within this framework is by demand being too high, whether that be consumption, government demand, or investment. Here again, we have the equilibrium of our IS and LM curves above the full employment level, and again we have an inflationary gap. In both cases, the fact that there is excess demand in the economy causes prices to rise, causes inflation. Both these situations are effectively what's known as demand pull inflation. They are demand driven and result from the fact that demand in the economy is higher than the full employment level, hence produces the inflationary gap. Now, it's also been argued that there is another form of inflation which characterises a large number of industrialised economies. This is known as cost push inflation. Effectively, this involves a push by workers for higher and higher wages. Higher wages then feed through into higher prices. And one of the arguments here is that increased unionisation has facilitated that push for higher wages. And hence, we've also have, on a number of occasions, cost push inflation within the economy. Now, back in the 1960s, where Keynesian policies were at the forefront, it was largely believed that it was demand pull factors which determined inflation within the economy. And this was further emphasised with the production by someone called Phillips of what purported to be a statistical relationship between the rate of unemployment in the economy and the rate of increase of wages. the rate of wage inflation. What it seemed to suggest was that the lower was unemployment, then the greater was wage inflation. Now, via a very simple cost markup type mechanism, one can transform this statistical relationship into a relationship between unemployment and price inflation. And it's this latter which became known as the Phillips curve. What it seemed to imply was that one could trade off some inflation for a particular rate of unemployment. So it seemed to suggest there was a trade-off between inflation and unemployment. And indeed, this is what some policymakers actually used as a framework for policy in the early 1960s. However, subsequently, if one looks at the period from the early 1960s onwards, when policymakers actually adopted that type of framework, it appeared that the Phillips curve was breaking down. And we can see this here by the fact that most of the relationships between unemployment and inflation, wage inflation, are well away from the initial Phillips curve estimated. And indeed most, if you look at the various periods there, lie to the right of the initial Phillips curve, suggesting that unemployment was now being associated with higher levels of wage and consequently price inflation. So we had, from the point at which this sort of trade-off began being used by policymakers, a breakdown of the Phillips curve. The statistical relationship which Phillips had established over quite a long time period, almost 100 years, was beginning to break down. Milton Friedman suggested that there was a very good reason for this breakdown of the Phillips curve. Governments continually try to trade off some inflation against lower unemployment, then individuals within the economy would begin to anticipate some inflation in the economy. So inflationary expectations would be generated. What he argued also was the point at which the original Phillips curve cut the axis, the point of zero inflation, was in fact the equilibrium in the labour market of labour demand and labour supply. And that any movement away from that point was in fact a disequilibrium situation within the labour market which could not persist. Now, he termed this point the natural rate of unemployment, the rate given by supply and demand in the labour market. And what he suggested was that temporarily one could move away from this situation, trade off higher inflation for lower unemployment. But that then individuals will begin to anticipate inflation in the economy, inflationary expectations will be generated, and that, in effect, a new Phillips curve would be established which incorporated those inflationary expectations. So that temporarily one can move up the original Phillips curve, then individuals begin to anticipate inflation and incorporate that in their decision making. Hence, it is incorporated within the equilibrium of the supply and demand for labour. Hence, eventually, one moves back again to the natural rate of unemployment. The labour market again moves back into equilibrium. Subsequently, the government can trade off some inflation for lower unemployment. But now, that inflation will be higher for any given rate of unemployment. So we can move up our expectations augmented Phillips curve, our second one there, again trading off inflation against unemployment. But again, eventually, that inflation is anticipated and we move to our natural rate of unemployment again. And the only way to trade off further is to accept an even higher rate of inflation. What that led Friedman to suggest was that in the long run, the Phillips curve would actually be vertical. Hence, in the long run, it is not possible to trade off inflation against lower unemployment. Given the breakdown of the initial Phillips curve, this does not seem that unreasonable a proposition. But if one looks at a number of industrialised economies today, then one wonders what that natural rate of unemployment actually is. Now, what a number of governments have tried to do is actually make changes to what they call the supply side of the economy to try and reduce that natural rate. So make changes to the structure of the economy. But to date, that has had very limited success, and there's not seemed to be much evidence that it has reduced that natural rate of unemployment.